We saw what happened to the 10-year, 20-year, 30-year Treasury holders during the last cycle in 2020. They got obliterated, had the worst bond losses in the history of the bond market. So that's a risk. That's duration risk. Well, if you own Bitcoin, it's volatile, but it's volatile to the upside.
Right.
So
it's a big difference.
It's a big difference. So it's okay. The volatility is okay because over a longer period of time, it's going to appreciate faster than the dollar depreciates, basically.
Right.
And that's the trust. And so it's easy to take market share from that bucket. So you can see that the pie is growing and Bitcoin's share of that pie is growing at the same time.
The financial world has been shaken. And if you're still relying on old school assets like bonds, you might be in for a surprise. The 2020 crisis exposed the vulnerability of traditional investments, leaving long-term bondholders with huge losses. What was once a safe haven now seems like a financial trap. Enter Bitcoin, a game changer redefining wealth preservation. James Lavish, in his latest interview, explains how Bitcoin's volatility, often seen as a drawback, is actually its strength. Unlike conventional assets losing value due to inflation, Bitcoin is rapidly gaining ground. As confidence in traditional investments weakens, Bitcoin is quietly emerging as the ultimate store of value. By 2025, Bitcoin won't just be another investment type, will outpace gold and bonds, becoming the preferred asset for wealth storage. This shift will redefine how we view money and investments. Now, let's dive into insights from James Lavish's interview. Don't forget to like, subscribe, and turn on notifications for more in-depth content. Enjoy the video.
Obviously, to you and me, Bitcoin it's sound money. It's hard money. It's something that cannot be debased. There's only going to be 21 million Bitcoin ever minted, ever created. And so it can't be manipulated like fiat money supplies. And even like gold, we've seen the madness out in London this last week, last few weeks, and what's happening there. And this is kind of an important thing because people think, but I buy gold, then I'm protected. But gold, if gold was not so manipulated, it would be at a much higher price. It would be, in the tens of thousands. It wouldn't be just hovering around 3. And so the issue there is that you have sovereigns buying gold. You have some worries about Trump tariffs and bringing your gold back into the States and having a sudden tariff on it. So you've got the COMEX is bringing gold back into New York and into the United States. And so you have players around the world that are buying gold, like the BRICS countries, to try to avoid having to buy U.S. treasuries in order to have dollars, because everybody still needs dollars around the world. But if you have gold, then you're supposedly protected. Well, the issue in the last few weeks out in London is that the Bank of England realized we don't have all the gold in our vaults. We can't just send it out. So it's going to take us 4 to 8 weeks to get you your gold. Okay, so then think about that. You got 4 to 8 weeks before you can get your hard asset that is supposedly hard and being held in a vault for you. Okay, that's number one. Then you've got to transfer it. You've got to transport it, which you've got to put it on. You've got to put it on a truck and a plane or a boat or something on rail to get it to wherever you need it to be. And it's got to be protected, so you have to pay for security for it. It's very heavy stuff. And they even said it, like, this is heavy. The Bank of England was on stage at a press conference saying, well, it's really heavy, so it takes a while to move. So if you want to move $1 billion of gold, think about all that would take to do that, to get it from London to New York. Then think about something like Bitcoin, where you have verifiable addresses and it's immutable. And you know that you look at that address and you see exactly how much Bitcoin is in that part of the blockchain, right? It's very easily auditable. You don't have to worry that it might be just gold-plated nickel. Like you saw in the JP Morgan vaults, they had $50 million of gold-plated nickel by accident. They didn't know about. Well, you know that's not going to happen. You can move it. You can move $1 billion of Bitcoin in less than 10 minutes for a few bucks.
Right.
It's staggering, and people are starting to catch on to this. And so the younger generation is very comfortable with that digital asset, that concept. The older generation, not so much. They love the gold, typically. My mom loves Bitcoin, but you have the younger generation now is looking at things like digital assets, and Bitcoin is one of those digital assets that is starting to bring people over to a new asset class, and it's emerging and it's growing rapidly, and that's the point. That the inflation, keep up inflation, and demographics. That's one side of it, but what you just hit on is that it's probably this is the key development for Bitcoin in this last 18 months. You've had massive tailwinds for this asset class, and we can talk through each of those. But just like you said, you have these sovereign wealth funds, institutions, very large, high net worth individuals coming into this new asset class because they know that and this is all game theory now, is that I need to get some of this before the price gets away from me. And then people look at it and say, oh God, it's $100,000. It's too late. I can't afford a Bitcoin now. Whereas, you and I know that that's just a number. Like the debasement's not going to stop. This is going to continue to go up in value, meaning the dollar is going to go down in value against it. So they're not sensitive to price like retail is. Like, some of the smaller players are, who only have so much money. They're very sensitive to the price of Bitcoin. Whereas you have Abu Dhabi come in, they could buy $500 million of Bitcoin,
and they did,
just go along in the market. Like I'm not price sensitive. I'm not waiting for it to get back to 70.
Yeah,
just participate and go along in the market, and that's what they did. And what's interesting about that is they bought the ETFs. Apparently, from the report, they bought ETFs, and so people would now say, "Wow, but that's just paper Bitcoin." It's not. The ETFs have a legal obligation to own the underlying Bitcoin. If you're a spot ETF like IBIT or like, FBTC or Bitwise, you have to own those the corresponding amount of Bitcoin to the NAV. Okay, so, but that is an easy way for any player to get in. Sovereign funds, governments, institutions, endowments, pension funds, they can just buy the ETF now. That's a super highway that's been built.
Yeah,
it's so easy for them to get on that. So institutional adoption is happening. It's happening quietly. You do see companies coming in and buying Bitcoin. You do hear about companies buying actual Bitcoin on their treasuries. But this is kind of like, it's all now forming and taking shape in exactly what you just said. It's becoming adopted as a new asset class.
Yeah.
As sovereign wealth funds and major investors flock to Bitcoin, it's clear that digital assets are carving out their space in the financial world. With unmatched efficiency and potential, Bitcoin is fast becoming a dominant player. While retail investors often see Bitcoin as speculative, institutions like hedge funds are adopting advanced strategies, investing in both Bitcoin and blockchain-related companies. Its increasing market share, alongside competition with gold, stocks, and real estate, highlights its growing role as a hedge against inflation. With its limited supply and decentralized structure, Bitcoin is set to become a crucial asset for high net worth individuals and institutions in the coming years. Now, let's check out more insights from the interview.
Like, what's the difference between how retail thinks about Bitcoin and institutional allocators and hedge funds would approach Bitcoin?
That's a good question. It depends on the type of hedge fund. And so if you're an active hedge fund, like really actively managing your capital and you're trading a lot, then you'll be trading Bitcoin and you'll be going long, you'll be going short, you'll have all kinds of strategies around it, put call strategies, you might be doing derivatives with it, you might be doing hedge trades against or pairs trades with other currencies. There's all kinds of stuff that hedge funds will do with the base currency, with the base asset. That's one type. Another type is, you'll be buying companies that are either involved with or are investing in Bitcoin themselves, things like Strategy, former MicroStrategy,
Yeah.
MetaPlanet, and other ones, Bitcoin miners, obviously. So that's another strategy. And then you've got, so that's kind of like the hedge fund world, non-endowment or pension funds. They would just be buying Bitcoin. Like, they're not going to be doing all this stuff. They might buy some of these stocks, but probably through some other agent, through a hedge fund or through another money manager, probably. But then on the other side, so it's got kind of like, just the regular hedge fund side. You got your VC side, which is the venture capitalists are buying super, super early stage, highly speculative, very young companies, not typically just not revenue generating. And so, but they have a basket or a portfolio of these investments, and they hope that one or two of them become unicorns to make the returns for the whole portfolio, because the reality is that most of those companies don't really make it after 10 or 15 years.
Yeah.
That's just the reality of VC investing. On the other side of the spectrum, you've got companies like investment companies or hedge funds that will invest in revenue generating companies that are a little bit, they're longer in the tooth, that are revenue generating, they're up and running, and have this window of 5 or 10 years where they'll really grow rapidly along with Bitcoin. And that's kind of in my mind, that's kind of a sweet spot of this industry.
What's a way or a couple ways that you think about how you sort of measure where Bitcoin's going?
Yeah, I mean, we talk about this a lot. You and I we just pulled up the chart before the show, taking a peek at it. The global assets, the total global assets. Jesse Myers puts this out, and that chart. It's funny. I made the same exact chart, and then I saw his in Saylor's presentation a couple days later. We were like maybe $10 trillion off here and there on the big pieces. But they look almost exactly alike. So the reality is it's a pretty definable set of investable assets in the world that doesn't include the derivatives. So if you just look at the investable assets, it's $900 trillion. But in that, Bitcoin is now 2 trillion. So it's a really easy way to visualize these big blocks that Bitcoin can start taking market share away from. So you've got gold is about 18 trillion. Then you've got your money supply and your real estate over 300 trillion. You got your bonds 300 trillion. You've got your stocks 120, 130 trillion. So where does Bitcoin start taking market share away from? Meaning, where do people start taking their allocations from and putting it to Bitcoin instead, reallocating their capital? That's one part of it, right? Really important part of it, though, is that where's the puck going? Where's that $900 trillion going to be in 10 years? Is it going to be 920 trillion? Or is it going to be closer to 2 quadrillion, which you thought it's going to be
1.6 quadrillion by 2030.
Yeah. So we're talking about 5 years from now.
Yeah.
It's a massive move, but that's probably, I would say that's right in the range. It's
not that big. It's 30 or 40%.
That's it, which is money supply 7 or 8% between now and then. There you are. Right. So that's it. So
if the money supply goes up by 8% a year for the next 5 years, where are we at?
Exactly.
Yeah.
That's exactly right. So that's pretty base case. It could go up a lot faster than that.
Yeah.
Right? The money supply could expand a lot faster than that, especially if we have another market shock,
right,
like we had in 2020. So if they print 50% of the money again,
yeah,
that'll shoot up really quickly. You better own some assets. You better own some Bitcoin. So where's Bitcoin going to take market share away from? Well, it's obvious that it takes market share away from gold and from stocks, where you've got people who feel like it's hard money and it's digital gold 2.0, and then you've got people who feel like it's just a risk asset and they're speculating with it. So it's taking kind of market share from both of those. So gold isn't growing as fast as I think it would if Bitcoin wasn't there.
Bitcoin's price has surged to $888,000, fueled by optimism surrounding potential U.S. trade policy shifts. A more strategic approach to tariffs under President Trump has eased economic instability concerns, boosting institutional interest. Hedge funds and sovereign wealth funds are now making massive Bitcoin investments, propelling it to new heights. More than just a digital asset, Bitcoin is proving to be the go-to investment for wealth preservation. Unlike traditional assets, Bitcoin offers unmatched efficiency, security, and borderless transactions, eliminating the need for physical gold and the risks tied to fiat currency inflation. The big players, hedge funds, sovereign wealth funds, and financial institutions are betting big on Bitcoin. This isn't just hype, it's the rise of a new asset class. As central banks continue printing money, Bitcoin's appeal as an inflation-proof investment is only growing. The future is here, and Bitcoin is at the forefront. How do you see Bitcoin's volatility affecting its long-term potential? Let us know in the comments. Don't forget to like, share, and subscribe. Thanks for watching.